In our final video for debt and credit, we'll be looking at just a number of the final issues with regards to credit analysis. So the relationship between the financial ratios and credit quality matters, and so we can see that credit ratings will mean lower credit ratings will mean higher yields, which we would expect, given that lower credit ratings is predictive of higher levels of default or higher probability of defaults. And rating agency rating changes actually also affect not only debt but also equity. So obviously, if the debt market thinks that the risk of a company has increased, then that's giving information not only to debt holders but to equity holders. And so there's substantial evidence that credit ratings can be predicted to a large degree using ratio analysis. And so Steve Gray, Alex Merkovich, one of our alumni, and Vinitha, one of our other lecturers, published a paper in this regard back in 2008. Another important note when we're looking at doing credit analysis is to understand debt covenants. So in the contract between the issuer and the borrowers, the issuer and the investors, there's often covenants. So these are contractual obligations that the firm has to abide to make sure that they don't enter into a default. So often these are negative covenants requiring the borrower not to take certain actions. So for example, they can promise not to take any more debt on. There can be often two types of interest or fixed charge coverage tests. So they need to maintain the ratio of earnings available to the interest or to fixed charges. Debt incurrence test applies when the company wishes to take on any additional borrowing, and we can also have cash flow tests or working capital provisions, and all of these covenants are designed to protect the investor and to make sure that the firm doesn't undertake particular actions which will increase the risk to the debt holder. So sometimes we have high yield corporate issuers, and so often these companies will be lower kind of credit quality, and the corporate structure is particularly important when we hold these types of debt, because there's potential limitations or restrictions on how cash flow may be able to flow from operating subsidiaries to the parent company or between them. So if we've got companies that are of high risk, then understanding the ability of the firm to move cash between its different entities will obviously be very important. You'd also want to review the covenants quite well, to really make sure you understand how you can protect yourself. And also, if it's a very high risk company, you'd also potentially want to undertake not only the traditional credit analysis, but you may want to undertake some of the analysis you do as an equity analyst to just ensure that you've got a good understanding of how this company might be operating in the marketplace and all of the risks that are associated with this firm. So obviously the higher the risk, the greater the analysis you would probably want to undertake. Just for completeness, we want to cover off on some of the other debt-like instruments which you may come across in your career. So a very common form of debt security is one that's called an asset-backed security. Here we could be talking about banks which have securitized mortgages and then created instruments and sold them off. So in this case, the debt securities are backed by a whole portfolio of mortgages. Some of the key things that rating agencies look at here is obviously the credit quality of the collateral, especially the amount of equity the borrowers have in the asset, the quality of the seller, the cash flow coming from these assets, and they usually do a stress test and look at the payment structures, and then obviously the legal structure. So how is it contracted? And then based on all of this analysis, they'll come up with a credit rating to do this. An asset-backed security transaction generally has greater certainty over the cash flows than a corporate bond, because we don't have the operating risk of a business, because in these particular assets they're backed by assets which tend to be not operating assets like a particular company. So often they can potentially be lower in risk, but not always. Another key thing to take account of when we're looking at debt is obviously sovereign credit risk. So here we're wanting to look at the economic risk, so the ability of the country to be able to pay, and the political willingness. So what's the political risk if we're going to be lending into these foreign markets? We also want to consider foreign exchange risk, so obviously that can become quite important as well. And then looking at the country's balance of payments as well. So is the company exporting sufficient goods and services to actually be able to afford to be able to pay any kind of debt that they've taken on? Obviously, when we're looking at credit and credit analysis, one of the key things we're looking at is financial ratio analysis. And so again, it becomes very important to understand, are there any accounting issues that we need to consider? So what are the various accounting methodologies that have been employed to come up with the financial statements, and are we happy with how they have used those accounting standards to come up with the actual accounting numbers? Some of the key things to think about is the consolidation basis. So is the economic entity defined as a parent entity, and does it include controlled entities, and how are they consolidating? What's the revenue and the expense recognition? So what percentage of completed contracts for that particular firm, and then compare it with how other firms in similar industry recognise revenue. Recognise that different types of methodologies can be more useful depending on the type of approach that you're wanting to take. So for example, a first in, first out method for looking at inventory can be better if we're wanting to assess asset turnover, for example. Because in this method, the value on the books is closer to market value, and so it will be kind of a better measure for the asset value. If we're looking more at kind of assessing probability, last in, first out will potentially be better in terms of being a bit more conservative potentially with the profitability. So you want to, again, this would be useful if it's an inventory intensive business. If they don't have a lot of inventory, obviously that kind of example would not be as important. Depending on what's important in that particular company, you might want to be looking at the depreciation and the asset lives if it's a really high fixed asset type company. Whereas if it's more of a software company, you might want to really drill into the intangible assets and actually how much goodwill is in the firm, and are those numbers realistic? You also may need to consider what are some of the other obligations on the firm. So particularly overseas, they might have pension obligations to past employees. They might have healthcare obligations to their employees. How costly are all of these things? You want to consider, does the firm have any other liabilities or contingent liabilities? So are there any environmental liabilities? Do they have to remediate mines? Do they have to remediate a factory site that they've been operating on. What kind of leases are out there? Have they guaranteed anything? If you can drill into these kinds of details, you'll have more confidence on your analysis. Finally, just some of the methodologies that they use in terms of calculating some of the line items in the income statement and the balance sheet. So how do they value cash and investments? Is that on a cost basis, or is it a market value? How are they accounting for their receivables? What are their provisioning like? Is it conservative, or are they being too optimistic? How exposed are they to different currency fluctuations? Things like that. If it's a conglomerate and there's various segments, how do they do the transfer pricing between these different segments of the firm? That's obviously important depending on where your debt's located and whether or not that segment will have the cash to be able to pay back. And then finally, similar to what we're talking about with equity analysts, you'd want to do industry analysis. So how is the firm operating within the industry? How is the industry operating? How risky is it? What are the opportunities? What are the threats? What are the risks? What are the weaknesses? A full kind of analysis of how favourable the firm is and the industry, and how risky is it. And if you undertake all of this analysis, you should be in a good place to be able to look at and understand the credit quality for this firm and the required rate that you would require on the debt for a firm of that level of risk. So that's what we'll look at this week in the videos. In class, we're going to go through the examples. We'll recap some of the key items, particularly some of the formulae, to make sure that we understand those, and we'll go through some problem set examples. Thanks for looking at all the videos and taking it all in. Thanks so much.